Sunil Singhania. He joins us in his new avatar now. So, now we have a liberty to perhaps get much more specific in terms of themes and sectors with him. So, Sunil, first, Happy New Year and thank you for joining us.
Happy New Year, Nikunj, to you and your whole team at TT Now, as well as the viewers. Wish them a great 2019.
But will it be a great 2019 for investors? Do you think we have all the ingredients which point to a good year, or this is going to be another challenging year?
See, first of all, I think for any equity investor, one has to be optimistic. If one is not optimistic, then one should not be an equity investor. So I think, we always start with optimism, and I do think that in a growing economy, it makes sense to be optimistic. Also, as far as challenges are concerned, I think we have seen so many challenges over the last few years, and challenges will continue. I think that's the essence of life. So notwithstanding the challenges and notwithstanding the fact that 2018 was a very challenging year, I think we remain quite optimistic about 2019 and the years forward.
I appreciate that, Sunil, that you need to be optimistic. But sometimes you also got to be realistic. I mean, 2008, if you would have become optimistic, then the optimism did not help.
No, I think you are talking and comparing it to a very different year where it was euphoric. I don't see that in the last 3-4 years we have at any point of time been euphoric, except a period of 6 months when specifically on the mid and small cap we had become euphoric. So I think the world overall is not euphoric, has not been euphoric, and I think that leads us to a credence that we are not seeing an overboard kind of a market where people are long left, right and center, there are leverage positions and so on and so forth. In fact, it's the reverse. People have been very cautious. Investors have not been investing as aggressively as maybe their cash balances in the bank are. There is definitely not an over-leveraged situation, not only in India but anywhere else in the world. So I think the situation is far, far different from the year you mentioned.
Sunil, hi, morning, and here's wishing you a happy new year once again. But just wanted to understand what makes you so hopeful, because 2018 was a year full of uncertainties, be it in crude, be it in geopolitical situations, or for that matter currency and the macroeconomic situation back home as well. But why is it that you're hopeful? Do you believe that maybe finally after that long wait we're going to see earnings recovery kick in from the next quarter itself?
So you mentioned it all. Oil has been a godsend for us, like from 85 we are down to 53, 54. Fundamentally, at least, we don't see oil moving beyond $60, $65, even the medium to long term. I think currency has come back to 70. If you see the last 20 years of trend, on an average, rupee depreciates by anywhere between 3 to 3.25% a year. But that's like a step-up function, so we have a 10-12% depreciation and then the rupee stabilizes for 3-4 years. So it is fair to presume that after this 10% depreciation, rupee should be quite stable for the next 3-4 years. Inflation is down, and going forward, the way oil prices have corrected doesn't seem to be inching up, despite the fact that we expect the MSP, the minimum support prices for a lot of farm products, to be increased. And consequently, the interest rates have also, from 8.25% for the 10-year G-Sec yields, fallen to 7.25. Internationally, there was this fear that US interest rates might inch up to 4%. In fact, they have fallen to 2.65%. US markets have been volatile, but again, my view is that it's a very healthy market, and I'm quite optimistic even on the US equity markets, given the fact that the S&P 500 is trading at like 14.5 times earning, which is like 7% yield in a country where the interest rates are at 3%. On the flows front, we have always had good domestic inflows over the last 3-4 years. Again, my view is that 2019 would be a change in the sense that foreign inflows should also be quite strong, both on the equity and fixed income side. And the last point, which you also touched upon, is the earnings bit. I think generally led by a couple of sectors, predominantly corporate banks, we do expect earnings for FY20 to even inch up to 20% plus in terms of growth. Obviously, a large part of that would be contributed by corporate banks, but other small sectors should also kick in. So I think overall, given the fact that we are not in a very euphoric zone, we are maybe at around 16 times FY20 earnings, and come 3-4 months ahead, and we would start to discount FY21. I think there is reasonable optimism both on the economy front as well as from a market front.
Sounding bearish, and my concern is not to really sound alarmist here, but I just want to be a devil's advocate, and my only concern with the current environment is that are we underestimating the fall in US markets? I remember this kind of a situation happened in 2007 when world discovered a problem called subprime. Indian markets, they started outperforming for many months now, and then we had this huge problem which started because of bear and stearns. Now the US economy may not be bloated up, but if the correction really kicks in more and more, could that have an impact on emerging markets very, very strongly? Today we can take a lot of pride by saying that US market niche gaya December mein, we were up and we are better and we have better growth. But will that really last for a long period of time?
So Nikunj, again you are, I think, comparing two different times and situations. 2007, as you rightly said, was more sort of a crash of a over-leveraged position. And in fact, I was yesterday seeing the documentary The Big Short, so it's very incidental that we're talking about it today. So I think it was more about the banking system being levered up like 40 times. If you see the banking system in the US now, it is very, very healthy compared to 2007, and in fact, in terms of their capital adequacy, in terms of their profitability, it's as healthy as it was ever was. Second is, we are not looking at PEs in US of 40-50 times. We are looking at a PE of 14.5 times for S&P 500. Again, just to give you a perspective, we have in the US had $1 trillion of buyback in 2018, and if you add the last 5 years of buybacks, they have total around $4 trillion, which is almost 20 to 25% of the market cap of the US. So I think we are seeing companies having huge cash balances, having huge cash profits. The economy is doing very well. If you go to US and you just talk to people, there is hardly any unemployment. In fact, there is shortage specifically on the technology side of people. So I don't see a scenario of something like 2007-8 even near that. And I would say that definitely things are much better and very different from 2007-8. As far as markets are concerned, yes, even there we had this phenomena of the FANG in the technology stocks, where there was a little bit of over optimism, and I think those are the stocks which have fallen the most over the last 3-4 months. So I think one segment went up very sharply. I think that segment has fallen off sharply. It is similar to what we had in India, where mid caps and small caps went up sharply, they fell sharply, or quality was getting a unusual premium, and wherever that quality is disappointed a little bit, and you mentioned a few stocks before I joined in, there you have seen a sharp fall. So I think it is more over optimism in a few stocks or a few sectors getting patted down, and the fall more pronounced there. So again, just to conclude, I don't see a scenario of like a meltdown of 2007-8. I don't see it even near to that. In fact, if I were an investor, I would also bet on the US markets from here on.
That's an interesting take, and Sunil, what a movie The Big Short is as well. But we had some interesting data thrown up yesterday with respect to the Russell 2000. A 10% fall historically has been followed by a positive year. So perhaps we could see that for the mid-cap index as well, because the negative year for the BSE mid-cap has always been followed by a positive one. Tell us a little bit about where you're seeing opportunity within the mid-cap universe. Where are you stock picking here?
So, Aisha, last 3 years we have seen, challenges which were quite significant compared to what we have seen earlier. And those challenges meant that, investors got comfort into so-called growth stocks, or, companies which had no impact with what was happening on the economy front. So consumption and quality got disproportionate PE. I think what we are seeing now is that that kind of multiples are not sustainable if you have even a slight sort of correction in their growth rates. And we have seen that with a large innerwear company, a two-wheeler company, of how the multiples have corrected very sharply. My view is that over the next 1-2 years, I think value will take precedence over growth. So companies which have been slowly growing but have not seen rapid growth have been ignored by the investors, and a lot of those companies are on the mid and small cap side. So I think going forward, maybe companies who are value, who have been in sectors which have been ignored for their challenging past, like maybe a construction company, maybe some old gen companies, capex companies, and moving towards them because they have seen sustainable addition to their balance sheet in terms of strength, in terms of their cash, and the high P stocks which were getting unusual sort of flows into it just because they were performing well. Maybe it's time to see money moving out of them into so-called value, and predominantly there even on the mid and small cap side.
Okay. Sunil, was hoping you'll get slightly more specific in terms of what are the themes you are betting on.
So, Nikunj, if you see, for example, there are a lot of power generation and distribution companies which are now trading at like 7-8 times cash PE multiples, and obviously the sector has been sort of a taboo sector because of all the stress they have undergone over the last 4-5 years. But I think going forward, India is a growing economy. We are seeing power demand growing at 7-8%. If we believe that there is going to be power for all, standard of living is going to improve, there is going to be growth in the power generation side as well as on the distribution side, because you need to take the power right to the final customers. Also, there has not been any significant addition to capacity. So I think companies which have good assets on the generation and distribution side, who have balance sheets which are not stressed or which can sort of cause a question mark as to their survival, I think some of these companies will do well. Also on the EPC side, one interesting phenomena in the September results which we were analyzing is the fact that for the first time after a lot of years, we have seen EPC companies not only start generating 15 to 18% ROE, but have also seen their debt levels go down. I think which is a dream for an investor in EPC companies, because last 7-8 years, EPC companies have only seen their balance sheets bloat by higher and higher debt. So I think these are some interesting observations, and obviously there are other companies in sectors which have been ignored because they don't grow fast. So I would say, again, a very boring sector, but maybe a few textile companies would be worth looking at. They are boring, they don't grow fast, but the kind of cash which some of these companies are generating, maybe in the next 3-4 years, you will have one period where they will give you like 50-100% return. So I think from an investor, what you have to look at is whether returns can be made in a block of 3, 4, 5 years, or whether you are looking at making returns every week or every month. And I think if you are in the former category where you are cognizant of the fact that returns will be made, but you are indifferent whether returns will be made in 3 months, but ultimately will be made in a block of 3-5 years, I think there will be a lot of companies which will keep on improving their cash flows, improving their balance sheets, and I think that is where the focus should be. On the other hand, there are companies which are doing obviously well, which are growing, which have huge brand value, which have huge ROEs and all, but at 60, 70, 80 PE, I don't see a scenario of these companies making you a lot of money unless the growth rates can last for 10, 20 years. So I think on the consumption side, our view is that stick to consumer discretionary, where the penetration is still low, where you can still hope to grow in double digits for the next 10-15 years. And I think that one of my favorite themes, the beverages sector, comes into play. But there are other few sort of emerging discretionary consumption stories which can also be looked at. But for a consumer staple kind of companies to give 50-60 PE, at least I don't find merit in that.
Sunil, got to ask you about financials, and I don't want to discuss the most popular trade, that's ICICI Bank, SBI or Axis, wherein it seems that there would surely be an earnings recovery. But within financials, since you do track this segment very, very closely, where else do you find opportunities? Can PSBs be looked at right now? Are there any brokerages or any other listed AMCs where you think there is both value and growth visibility?
So I agree with you that corporate banks are a sort of a consensus trade, but despite that, I think a decent returns should be made there, because even now, I think the markets, at least according to us, are underestimating the recovery as far as earnings is concerned. On the other sub-themes, we like select niche NBFCs. I think the current issue over the last 3-4 months has meant that the competition from new NBFCs will reduce quite significantly. And NBFCs which are well capitalized, which have a history of managing risk quite nicely over the last 5-10 years, will get a disproportionate sort of growth opportunities because of lack of competition or reduction in competition. On the other sub-themes, we like insurance as a theme, though we would like to wait for the markets to give us an opportunity which is much more entailing. I do believe that India is going to grow in terms of its both asset as well as wealth management businesses because of the huge savings which we have and still under penetration. So I think select wealth management companies which we can play through maybe a few brokerages definitely looks to be a good option. A good thing is that we have seen valuations now much more reasonable than what they were 3-6 months back, and I think at this point of time we would be very constructive in quite a few NBFCs across different segments. I think a few where we still have issues are obviously again the consensus kind of things which are wholesale funded, a lot of exposure towards real estate. I think that is one segment where we are not seeing an uptick, at least as far as the high-end residential markets are concerned. There's a lot of regulatory headwind still, and savings which were going into real estate from an investment perspective have completely stopped. And I think that also makes us believe that those savings will come into the asset/wealth management space. So we're better off playing the savings part through the asset/wealth management companies rather than trying to bet on NBFCs which are more exposed towards real estate.
It's a listed company now, Reliance Mutual Funds. No, my question to you is that since you are bullish on asset managers, would you buy your previous company, Reliance Nippon AMC? It's a listed company now and it's a player in asset management.
So as I said, the business of asset management as well as wealth management is definitely good. There are near-term headwinds predominantly from the regulatory front. The reason I started my own company, Abakkus, is because of the fact that I'm quite bullish on this segment. And at this point of time, my biggest investment in an asset management company would be in my own company.
Appreciate your time. Glad you could join us and have a wonderful 2019 ahead.
Thanks, and same to you. Thanks, Aisha. Happy New Year to you too.